And yet we have a Federal Reserve and a government that continues to pound the table and worry about deflation. Yet it is inflation that they're creating. This was changed by the Germans, and they changed their currency and created a Rentenmark. Essentially, one of those became 1 trillion marks, soaked up some of the currency. They stopped inflation. And the Germans, and of course you've already heard from Professor Holzman how smart the Germans are over and over, and I'm sure you'll hear more of that. But they have hyperinflation burned into their memories. Americans do not have that burned into their memories, but they may yet, before this is all over. Now, I wanted to leave the subject of money and go to something that I know a little bit about because I was a banker, although most of this banking I'm going to talk about I never engaged in. But we're going to talk about banking for the second half of this. And I'm going to start with loan banking. Actually, I was a loan officer, made real estate loans till that didn't work out very well. But loan banking is straightforward enough. If I wanted to start a bank and save some money, I might start a bank and I would initially loan out my own money and earn the profit from the interest that I had earned from the borrower who would pay, and the loan would be repaid, and you would do it all over again. You may want to take in investors. You might want to sell bonds, and then again you would loan that money out, and you would earn a profit on the difference between what you'd pay the bondholders in interest and what you would receive from your borrowers. And the banker would get paid for being an expert on where its loans should be made and to whom, and would reap the award for this service. There's no inflationary action by being a loan bank. The money's been saved, a present good has been traded for a future good, and the money has been lent out. So there's no money being created out of nowhere in this case. If the bank makes unsound loans and goes bankrupt, as in any other kind of insolvency, its shareholders and creditors would suffer the losses, and that bankruptcy would be no different than any other. Unwise management or poor entrepreneurship would cause the harm to the owners and the creditors. Now, a good example of straight loan companies are what I call hard money lenders, finance companies, and factors. Those are all loan bankers. And an example of a factor, if you're not familiar with that, is CIT. Now, you may have heard of CIT in the news. They are on the brink of bankruptcy. They were saved by some of their bondholders, extending them another $3 billion, but I think that's only going to last them a month. But again, they don't have depositors. They have more bondholders. Hard money lenders were lenders in hot real estate markets that would loan on real estate. Developers who couldn't borrow from banks, didn't want to borrow from banks. A hard money lender would gather a pool of saved money from investors, pool it together to make real estate loans. Generally at high rates of 12%, 15%. So even when prime was 1 and we might charge 2 or 3 over prime for a loan, so the bank's getting 3 or 4, the hard money lender would be typically getting 11 or 12 for the same kind of loan. Because generally people who have actually saved the money and are foregoing consumption, they don't generally want a higher return than somebody that just has their money in the bank that is FDIC insured. So many of these hard money lenders have been devastated through the real estate crash, but you don't hear a lot about them, but I would predict that you will hear more and more, because there's been a lot of investors who've lost a lot of money investing in through hard money lenders because they didn't think real estate would ever go down in value. And they are learning that lesson very quickly. So let's turn to deposit banking. Legitimate deposit banking is based on, in my view, honoring property rights. If you put money in a bank, especially in a demand deposit account, you probably consider it your money, right? If you have money in the bank, does anybody here, if you've got a checking account, do you think you've lent the bank money? You think you have? You've lent it to them. Okay. A lot of people would, so on your balance sheet, would you, that money, would you call it cash or would you call it loan to bank? Or loan receivable from bank? In a demand deposit where you can pick it up anytime? Yeah, not talking about a CD in this case, but demand deposit, most people would consider their money. They can go and get it any time. Whereas in a CD, you have lent the bank money for a certain period of time, and you have a contractual obligation, and they can do what they will with the money. But most demand deposits, if you put the money in one day, you can go back and get it the next. And so, yeah, the expectation is that they're holding the bank, holding that money for you, but that's not the case. All men, of course, this started with the goldsmith bankers a long time ago. People would put their gold with a goldsmith banker, and he would hold their gold. Eventually, these goldsmith bankers would say, gee, I think I can print more tickets than I have gold because I don't think everybody will show up for their gold all at once. And the more tickets I have out, the more money I can create and the more money I can earn. And that's what's happened. I mean, all men are subject to temptation to commit theft and fraud, and the warehousing profession is no different. And short of just flat stealing the depositor's stuff, in this case the money, warehouseman would borrow it temporarily with the hope and be able to hopefully profit by the speculation and then return it later. Of course, this is called embezzlement. Embezzlement in the dictionary means appropriating fraudulently to one's own use as money or property entrusted in one's care. And of course, nothing is more tempting than gold bullion or money for embezzlement because gold is fully fungible. So these goldsmiths, deposit bankers, virtually always embezzled because it was profitable to create money out of nowhere. So over time, bankers and government have found it important to find an adequate theoretical justification beyond the easy solution of simply declaring legal a corrupt criminal practice, which is ultimately what happened. But what happened in 1811 in Carr versus Carr was a very important court case, and that is when the court determined that the debts mentioned in a will that it was included as cash balance in a bank deposit account, the Master of the Rolls, Sir William Grant, ruled that it did since the money had been paid directly into the bank and was not earmarked in a sealed bag. It had become a loan rather than a bailment. 5 years later, in Devanes versus Noble, the same judge ruled that money paid into a banker's becomes immediately a part of his general assets, and his time merely a debtor for that amount. 1848, Foley versus Hill and others, Lord Cottingham ruled money, when paid into a bank, ceases altogether to be the money of the principal. It is then that the money of the banker, who is bound to an equivalent by paying a similar sum to the deposited with him when he is asked for it. The money is placed in a custody of banker to do what he pleases. So we had this series of court cases that turned deposit banks from bailment and essentially created the legal justification for what we know as fractionalized banking. Now, all these court cases remind me of a scene from a John Wayne movie. There's a movie called The Comancheros. I don't know if you've seen it, but Circuit Court Judge Thaddeus Jackson Breen says to Paul Regret, "Major here has told me about your troubles. I've been thinking it over in light of my 40 years experience in legal jurisprudence and have come to the positive conclusion that there ain't no way to do this legal and honest, but being good, sensible Texans, we'll do it illegal and dishonest." So I think that kind of wraps up the way the courts have held on the deposit issue. So law's been deliberately ambiguous to legally justify fractional reserves, and this is needed because fractional reserve banking cannot survive economically on its own. It must be supported by government force in the form of a central bank, which institutes the regulations and supplies liquidity necessary at all times to keep the apparatus going. So what we've done now is, you can see we've married, if you will, the loan bank with the deposit bank. And that's when we create fractional reserves. So if you put $100 in the bank, they don't have $100 of your money waiting for you. They probably have lent out $90 of it. And the hope is that not everybody shows up to get their money all at once. And of course, when things go bad, there's rumors out that loans aren't being paid off because of the $100 you put in the bank. The $90 was lent to the real estate developer down the street who built some houses that he can't sell anymore, so he can't repay the loan. So people get wind of this and they want to come and get their money. And when everybody wants to show up at once and get their money, and it doesn't take everybody, if say 5 or 10% of the people want to show up and get their money, they can't get it. So you have what's known as a run on the bank. And the last time there was really runs on the bank was from 1929 to 1933 during the first Great Depression. And we had 9,200 banks fail in the United States. So we haven't had this many fail this time around, but we are on our way. I'm not sure it'll be 9,200. There were many, many more banks back in the early 30s than there are now. So, but 92 of them did fail. We actually only have about 8,500 banks in total in the United States right now. And I think as of last Friday, 7 more banks failed. I think we're up to 64 or something like that. So a fair number of failures now with this real estate meltdown. Now, fractional